Hello, bro. Welcome to MTF. So, this will be a complete guide to forex trading, all the details about trading. Now, first of all, we have two things that you have to be doing in forex market as a trader. At first, what you need to conduct is a thorough market analysis. Now, we have two things you should focus on. First of all, I said market analysis. Now, after market analysis, there's something else you need to focus on, which is trade execution. So, number one is market analysis, then number two, you go to trade execution. Now, that first of all, market analysis is something like a roadmap to what we're going to be doing during trade execution. So, now what is market analysis? Market analysis is simply identifying the overall flow, the general movement of the market, like the general direction of the market on higher time frame. So that's what market analysis is. Now, how do you approach market analysis? To do market analysis, first of all, you need to approach it from the monthly time frame perspective. On the monthly time frame, what you need to be looking out for is the general direction of the market. So the monthly time frame explains the general direction of the market. For example, in real life scenario, for example, you are in the middle of nowhere, like you are traveling to any community and you get to a place that you are stuck, you don't know what to do, you don't know which route to follow. You need a guide at that time, something like a Google map. So a Google map now can give you direction from that particular spot that you are in currently. From that spot now, the Google map can easily lead you to your destination, pointing an arrow to the road that you need to follow. So that's an example of a monthly time frame. So monthly time frame is your Google map when you are trading the forex market or even crypto. So this strategy, you can use it to trade any market. So you can use it to trade futures, you can use it to trade crypto, indices, forex, any pair at all. So first of all, I said you start from monthly time frame. Monthly time frame is a Google map where you come to get your direction, the overall flow of the market on the monthly time frame. Now, after your monthly time frame, come to weekly time frame. Don't worry, I'm going to be doing everything practical. I'm just giving you the guide of what you're going to do gradually. So you come to weekly time frame. On the weekly time frame, the weekly time frame is like it has a solid foundation, like a concrete time frame, unlike the monthly time frame. So both the weekly and monthly time frame are concrete time frames. So now on the weekly time frame, you come to weekly time frame to plot key levels. Key level like your support and resistance zones. Then you pay close attention to those key levels whenever markets approach those levels. So the work of the weekly time frame is for plotting of key levels and possibly chart patterns. Now, after engaging your monthly time frame and your weekly time frame, you come to the daily time frame. Now, what are you going to be doing on the daily time frame? Daily time frame is the time frame that you consider trading the trend. So daily time frame is the tradable time frame. Daily time frame is the tradable time frame that you consider the trend. And now your daily time frame should be in line with your monthly time frame. Now, for example, the market is saying buy on the monthly time frame. Your daily time frame, the market is saying buy on the monthly time frame. Then you plot your key levels on the weekly time frame. Now, on your daily time frame, you want to see a trend that aligns with the monthly time frame. Since the monthly is saying buy, you want your daily time frame to align with buy. So you want to see a buy trend on the daily time frame, knowing fully well that each month will give you about 22 daily candles, because we have 5 days in a week to trade. We have 5 days in a week to trade, and Those 5 days can amount to 22 days in each month. So every monthly candle have about 22 candles, daily candles, that's 22 days. So since the monthly is saying you should buy, you are going to be seeing 22 buys on the daily time frame. Not instantly, but they're going to be popping up gradually. So you are going to be focusing on that buy trend on daily time frame. So that is what daily time frame is. So taking your decision from monthly perspective alongside with the daily trend. Now, after getting those things in place, so you have now known what a monthly time frame is meant for, and a weekly time frame you also know what it's meant for, and a daily time frame what also a daily time frame is meant for. You might be asking a question that, am I going to be going to monthly time frame each time I want to do my analysis? The simple answer is no. I will consider telling you that whenever you are going to do your analysis, the monthly time frame you can check it once in a month. You can check your monthly time frame once in a month. Already, that will tell you the direction for that month. Then the weekly time frame, I will suggest you can check your weekly time frame like once in every week. Like this, for example, this in a week, you can check your weekly time frame once. But the daily time frame, you can constantly check it every single day. Every single trading day, you can constantly check your daily time frame. So that is the simple answer to the question that's popping up on your mind right now. Now, after getting those 3 time frame in play, you go over to trade execution. So you go to trade execution after market analysis. So market analysis and trade execution are two different things. In the sense that market analysis is just the Google map to where you are going. Then trade execution is like entering the bus that will take you to that location that the Google map is telling you. So that's the simple difference. Knowing where you are going is one thing. Then the means at which you are going to get to that place that you are going is the second thing. So the Google map is from the monthly to daily time frame. That's where you get your overall direction and trend. Then the trade execution is now the bus that will take you to your destination. Now, trade execution can be considered on 4-hour time frame. Between the 4-hour time frame and 1-hour time frame, you can consider taking your trade execution in between those two time frames. Although if you are a day trader, you don't like the aspect of a big SL levels, you can also do it successfully. The question in your mind is, how can you do it successfully? So yes, you can do it. What you need to do is, first of all, let your setup align first from between the 4-hour and the 1-hour time frame. Let your setup first of all align. Since the daily time frame is telling you it's a buy trend and you are seeing a retracement before the buy can continue, what you simply do is you come to 4-hour time frame to wait for that retracement. Get it? Wait for that retracement to align first. So once the buy is about to kick off on the 4-hour time frame or 1-hour time frame, when the trend is about to kick off, you've seen confirmation. All you need to do is go to your execution time frame, your preferable time frame, like 15 minutes or 5 minutes. Then you take the execution there. It doesn't matter the strategy. If you follow the exact step, you are still going to get the same results. So now you've now known what a trade execution is. Now, what type of setup should you look for under trade execution? First of all, since this is a video for all my students on MTF, sharing the complete trading setup that I use. First type of setup you should look for is counter trend line break. So now, using counter trend line break, for example, if GBP USD is in an uptrend, the pullback from that uptrend will be a sell. The pullback, I mean the retracement. If we are buying to some level, let me give a little example with line. So for example, if GBP USD is buy, going something like this, buy, this pullback that is coming down from here is what I call the retracement. So this is what I call the retracement, something like this. Now, what you do when you see this type of retracement, because it's a counter trend line setup. Remember, this retracement, if you since it's on a daily time frame, you are seeing the retracement on a daily time frame. What you need to do, you come to 4-hour time frame. You come to 4-hour time frame. If you come to 4-hour time frame, you're going to be seeing stuffs like something like this. Market will come down like so, go up like so, come back down like so, go up, come down, go up, come down. So you're going to be seeing something like this on the 4-hour time frame. So for example, this whole retracement is happening on the daily time frame. You come to 4-hour time frame. That is where the counter trend line break does its magic. Now you wait for, since it's something like this, you just plot your counter trend line exactly here. Plot your counter trend line here, just like so. Remember, for a trend line to be valid, it must have at least 2 touches. So even the counter trend line must be valid. So you must get at least 2 touches to call it a valid trend line. So 1 touch, 2 touches. So this counter trend line is valid. Remember, the overall trend is up. Remember, the overall trend is up. So this one is just okay. A counter trend line is a trend line that is going against the overall direction. That's why it's called a counter trend line. Now, for example, think let me give complete space to make this a valid spot. So for example, these are not trend. The overall market direction is pointing up. The overall market direction is pointing up. So on the daily time frame, we are in an uptrend, something like so. We have the first or the second touch, so it's a valid trend line. Now, a counter trend line is the one that goes against the overall trend line. That's what you are seeing like this. Now, the break of that counter trend line is where you need to execute your trade. So you will allow the counter trend line to be taken out. Allow a 4-hour candle close. I'm not talking about 1 week of a candle just close above the trend line, counter trend line, and blow back inside. That's not considered a break. So for this counter trend line to break, you allow it to break with a full body close. If possible, allow it to take out one of the recent highs that triggers the move before the break. Allow it to take, just like in this scenario, you see the recent high here and the recent low. Instead of creating another recent lower high to create a lower low, you need to wait for a strong candle to break above this recent lower high that created the lower low, something like this. Then this spot now is where you need to take your trade, take a long position in line with the daily time frame, because the daily time frame is already in line with monthly. So this is where you place your trade order, your buy. Then your stop loss goes below the lowest point that the market came before the break, something like this. And this will now bring us to the next question. And in this case, where will be the first TP, which is the first take profit level? Your first take profit level always goes to the 100%. Now the 100% is this place where the retracement started from. This spot here is 100%. So this is where your first level target should always come. No matter the risk to reward, your first level target, the place where you should consider taking out 10 to 20% of your profit, is always this 100% retracement. because market can easily come to this place now and make a double top, then revert back to the downside. So that's why it's considerable you take out something from here. So once you take out small profit from this place, you shift this stop loss to entry. Then the trade will be risk free. Then you allow it to continue run. As the trade is moving in your favor, you are shifting your stop loss into profit gradually alongside with the market. The more the market goes, the more you shift your stop loss little by little. So that's how you approach a counter trend line break. So inverse of this is what you are going to be seeing in a selling market. So for a selling market, for example, the daily time frame is on a sell trend. You also wait for a counter trend line like this. There is for a bullish execution, you are going to be waiting for a bullish engulfing candle to break out of the counter trend line and take out recent lower high. So bullish engulfing is what you are going to be looking at for this one. Then if it's if it's a selling market like a sell trend, and so for a sell trend, the counter trend should be a buy. Then you wait for a bearish engulfing to blow past the counter trend line for buy. Just bearish engulfing that just cuts through the counter trend line. That's where you execute a sell. So that's flip. If you flip your phone upside down, you are going to be seeing this as a sell trend. So that's exactly what I'm explaining. So that's it for the first trade execution system, which is the counter trend line execution. Now the second execution is what we called the Fibonacci retracement bounce. So the Fib retracement bounce is the second execution. Now how is that one? How does that one work? So for example, the daily is an uptrend. It's in an uptrend, just like what you are seeing like this. It's in an uptrend. When this retracement started coming down like this, you pick your Fib retracement too. If you don't know how to set your Fib to be like mine, check the channel. You are going to be seeing you see a complete guide to my trading view setup. Then you set up your own like that. So for the buying market, you draw your Fib from the recent low that triggered this impulsive move to the upside before the retracement started. You draw from that recent low, just like so, to the highest point where the retracement started from. You drag it just like this. Now the logic of this is that when the market comes between this region, let me make my Fib bold enough for you guys to read the coordinates clear. You measure your Fib from the recent low here to the recent high where the retracement started from. Now the area you need to focus on is this 0.50% level and 0.618. So from year to year is where you are going to be looking to execute your trade on the Fib bounce entry strategy. So you wait for this market to drop to this point here. Don't trade off from this region. Always wait for the bounce off. Now, when I mean the bounce off, wait for the market to do something like this. Blow out of the 61.8 and 50 region. Blow out of it just like so before you take your trade. Blowing out, I mean, is something like a strong bullish engulfing candle for a buy and a strong bearish engulfing candle for a sell. So that bearish and bullish engulfing candle is very much important before you take any trade. So once you see a strong bearish engulfing candle that blew out of this zone here, that is where you need to take action and place your trade. If it's an uptrend, you need to place your trade just like so. then your stop loss will now go below the fib zone, because the fib zone will automatically be the last range, because you are going to be getting a lot of candle sync range here before the bullish engulfing blowout. So your first level target, see the same rule with the counter trend line entry. The first level target will always be 100%. Then other key levels like the fib essential might be your next target. So once you hit your first level target, you shift your stop loss to break even entry. Then the more the market goes to your favor, the more you adjust your stop loss in profit. So that's how to approach the two trading trade execution scenario. Now let's go to a live market to explain everything that we've said so far. Let's go to live market to explain all completely. Okay, so like I said, when you are conducting market analysis, at first, when you open your chart, the first thing you should do is market analysis. Now, when you're conducting market analysis, first of all, you go to monthly time frame. Now, this is on 4 hour time frame. So I will switch straight to monthly time frame for market analysis. So now this on monthly time frame. So what I will do, I'll zoom in to see the direction which the monthly candles is currently pointing for us. Now, if I look pretty much on this market, I will see that this market is doing something like higher high, higher low, higher high, higher low, higher high, higher low, higher high again. We needed, ideally, we needed a higher low at this region to continue, but for some reason, market come back to the origin of this move. So the low that triggered this higher high again, market partially came back to it, but at least we did not close below it. If, for example, we closed below it somewhere about here, we would have considered that the market is going to continue selling to somewhere this region. But as long as the market went back above it, we are still at least bullish on this pair. So we are still bullish on this pair because the market is still respecting the trend, I would say partially. So if we look at the candle close of last month, another thing that would have made us consider is selling this market is last month. So this candle now, it went down before, assuming it closed below this bullish candle here, assuming this red closed below here, we shouldn't have been looking for anything buy again. We should have considered selling, but as long as we had a long week and formed something like this, a hammer candle, I think we still have a little more pressure to push to the other side, maybe somewhere around here, this level here, maybe somewhere here, before we can see the market reaction and know if we're going to continue further up or down. So the monthly time frame now is still telling us that we still have a little bit strength to push to the upside. So now this is what we now came out the outcome of the monthly analysis. This is exactly what we came out with. Now I'll zoom in. I told us weekly time frame is for plotting zones, so but you are going to zoom in to get a clear view of where you're going to be plotting your key levels. So I'll plot out one of my rectangle to draw it from end to end, just like so, because you must need a lot of touch. So all these tools that I will be using on this class, you guys can see the setting on the recent post I dropped on the group. You can check there and you access the whole setting there. So I just plot one of these levels. I'll be cloning it on the weekly time frame to locate my support and resistance regions. So we have gotten the direction on the monthly that we are still on an uptrend, bullish. The market is bullish for the month. So I'll go to weekly time frame to plot key levels. Now this on weekly time frame, I'll have to clone this level. I'll first of all check if I'm satisfied with the length of it. I think I'll adjust it a bit. Let's see. I think it's a bit fine for me. Then what I will do, I'll clone this level to look out for other subsequent support region that can possibly hold the market. Now, support and resistance are like upstairs, someone living in upstairs. When you are on the downside, on the down floor, you are going to be seeing the upper floor as a ceiling. But when you climb to the upper floor, you are going to be seeing the initial ceiling that you are seeing will now turn to your floor. So that is what support and resistance is. When you are coming down from that upper floor to the downside, that floor that you are stepping on before will now turn to a ceiling. So looking at it from the down floor, you are going to be seeing a ceiling. Then looking at it on the upper floor, you are going to be seeing a floor. So that is exactly the simple definition of support and resistance. So if I clone this guy, this is support. The lowest place the market came to before reversing to the upside is a support. Then the highest place the market went to before reversing back to the downside is what we call a resistance. So if I should clone this guy now, if I should clone this zone, I will drag it to the next region, which is somewhere here. If you notice, initially this place was a support before the market bounced out to the upside. Then when the market came to that place again, respected it before the market blew past it. But when the market blew out of it, it retested it. So initially a floor, but now a ceiling. Then the market came down. Now this one now is now the new floor, the new established floor. And now this turns to a ceiling. Now look at it. When this market established a floor here, he went back and tested the ceiling, bounced off, tested it again, bounced off before breaking it. And when we break it, we turned it again to a floor. So this is the logic. We turn it to a floor. After turning this to a floor, what did we do? Market established another ceiling around this place. So I can easily clone this guy here now. I can clone it, drag it to this point as a new floor, as a new ceiling, just like that. Any level you plot, make sure you lock it so that your mouse or your hand won't mistakenly shift it, just like what just happened now. Just like this, you lock it so that you don't mistakenly shift it. So I'll also lock this guy, then clone it again. Just keep cloning it and look for the obvious support and resistance. So this is also the next ceiling that the market created. You can see when we broke out of this ceiling, we created another ceiling at the upside, established another ceiling. Then we came back to turn this broken ceiling into a floor, which is into a support. So that is just the logic. Now I'll clone this again, because after turning this guy now to a ceiling, we broke it again to the upside and established another high, which is probably somewhere up there at the roof. So I'll drag it to here, this guy here. So I'll lock it and lock this one too. Excuse me. So I'll lock this guy also. So this is how you plot your key levels on the weekly time frame. So just like this. So these are the key levels you have to play with. Because if you also look at it, know that these are the things that big guys usually pay attention to. So monthly for direction, weekly for plotting of key levels and chart patterns. Now, after plotting all these key levels, there's something else you need to plot. There's something else you need to plot. So in between from this, excuse me, from this major level to this major level, the center of it, market also have some type of reactions. So I pick horizontal line and I'll just with my eye, I'll measure from here to this place, the 50% of it. The 50% of it, I'll just calculate with my eye and plot my level there, minor level there. So that tiny line you're just seeing there, don't play with it. This is a bad guy that can easily hold the market. If you're going to be selling, this guy can hold the market and bounce it off. Just like if you look back in time, you see when we broke out of the minor line, we retested it, went up, tested it again, went down, tested it again, went up again, tested it, came back, tested it. So you can see this guy is pretty much strong. So this is how you plot it on the 50%. So I can see decide to plot again on the upper side based on if the market is going to continue up, we still have another 50% level here. You can see it also had reaction. So whichever side we go now, we are prepared here. So when we blow past here, we also plot the 50 level here. So that's how you plot your key levels on the weekly time frame. So we go straight to daily time frame to check for the immediate trend. Remember, monthly is telling us the market is going up. So it's a buy on the monthly time frame. Now you go to the daily time frame. After plotting your key levels on weekly, you can easily zoom in to check for chart pattern or candlestick also. But the monthly is already telling us it's a buy. And the weekly we had last week closed bullish. So this is the current week that we are in. So we are still expecting a push to the upside according to the monthly. And the weekly is already in line. So we go to the daily time frame to check the tradable trend. I believe you're understanding what I'm explaining. So now this is the daily time frame, which is the tradable trend. Remember, this is our major key level. So the tradable trend now is what we are observing. If you look at this, this was the origin of the tradable trend. This an impulsive move to the upside, a retracement, and another impulsive move to the upside. Then this another retracement. So this retracement now is supposed to trigger another impulsive move to our major zone. So that's just a clear definition of it. Now, the daily time frame is also pointing to our next major zone. So this guy now is clearly pointing to the upside. Now we'll come to if we should plot the counter trend line to see that this guy is valid. Let's go to, since this is the retracement that should trigger us to buy to the major zone, we'll come to 4-hour time frame, knowing that the daily time frame is in line with the monthly and the weekly time frame. We'll come to 4-hour time frame to plot a counter trend line for trade execution. So that moving from the monthly now to this daily time frame. Let me go back. So moving from the monthly time frame down to this place that we have seen our retracement now, this is what we call market analysis. So this is market analysis. Now we go straight to trade execution, which is straight to 4-hour time frame. Now this 4-hour time frame. on 4 hour time frame, this is our retracement. This is the retracement. So to plot my counter trend line on this guy, I'll bring out my trend line to trend line. Then this is already a double top, so if I should plot trend line here, I don't think it will be. Okay, I think it's also good here. So this can be a trend line, and this also can still be another trend line. Another trend line somewhere about here. Then I'll lock it. I'm already on this trade, so currently as we are doing the analysis, I've already executed trade on this pair. I executed trade on this pair since on 26th of August 2025. So I've been on this trade right from this point here because I use 1 hour execution from here. So this is a counter trend line you should be playing with. So when this market break, earlier on Sunday I told us that if we see a bullish engulfing candle blow out of this counter trend line, you can execute a buy here. You can execute a buy at the radius of it. So which that already happened. So our main target after the break of this counter trend line, your first level target. Your first level target is somewhere about here. So that's your first level target. That's your first level target. So counter trend line, and you can see this guy, this was the last low. This was the last low triggering this impulsive move to the upside. You can easily use rotated rectangle at this point. Let me see something like this. So something like this, and you also lock it. So this is what you should be checking up on. Then you put your long trade exactly at the break of that counter trend line. So anything that makes this market to retrace to this place, wait for a bullish engulfing candle and take a buy. So this is exactly how you conduct market trade execution. Stop loss will be around this point here. So if you see a bullish engulfing off from this zone, that's where you should execute a buy trade here. Now, knowing that this is what you're looking out for, if you are a day trader and you don't want to be executing such a setup, you wait for this market to come to your zone on the 4-hour time frame. You wait for this market to come down to, excuse me. So you wait for this market to come down a bit to somewhere here, giving a bullish engulfing candle. A bullish engulfing candle close off from this yellow zone here. Then you go to your 15 minutes time frame and look for minor pullback and execute your buy from there. That time you're going to be having a smaller stop loss. You're going to be having a smaller stop loss from that time. But if you're comfortable with taking swing trade, you can easily take your execution on the 4-hour time frame or the 1 hour time frame to a bullish engulfing candle close. So this is for first trade execution system. First execution system. So this is how you do it. Now I'll take this off and explain. Yes, your move. So I'll take these guys off and explain the next execution system, which is the fib bounce, the fib retracement bounce. Now initially I told us this was an impulsive move to the upside, a retracement, the next impulsive move. Now this is the retracement. I told you for uptrend you draw your fib from the recent low to the recent high. But if it's if it is a downtrend, you draw your fib from the recent high to the recent low. That's for downtrend. But for uptrend, recent low to recent high. So just get that in mind. So since this is the recent low that triggered this move that is now forming this retracement, what you do, remember this is on the daily trend. This is on the daily trend. You just draw Fibonacci, then go to 4-hour time frame to get confirmation. So I'll pull out my fib retracement from the recent low here to the recent high. Remember, I told us the bounce is what you should trade. You don't place trade on the fib level. You don't place trade on the fib level. You place your trade at the bounce. So, for example, the recent low to the recent high. Now, when this market is retracing, inside this region is where you'll be looking to get your confirmation. They bounce off of it. You can see a tweezer bottom candle. This is a complete clear tweezer bottom candle that came to test the zone, then bounced off to somewhere here. Preferably, I'll be waiting for a bullish engulfing, but seeing a tweezer bottom, you can also take an execution. So seeing this candle reaction here, I'll go straight to 4-hour time frame because you don't execute trade on the daily time frame. I'll go over to 4-hour time frame. You see on the 4-hour time frame, after the bounce, you see a strong bullish engulfing candle. Then this was a retracement. When I executed this trade, at this retracement, I plotted a level there. After the fib bounce, this was the fib region here. Remember, let me just mark out the fib region on the daily time frame so that it will be clear in your eye. So this is the fib region. Then I'll take out my rotated rectangle. So this is it. This is the fib bounce. I'll take this fib off for a clearer view. Now on the 4-hour time frame, the fib have already held the market and it bounced off. I drew at the bounce off when this market was retracing. All in my mind is that let's take out the high of the retracement. Then I will know that the market is valid. So I plotted another retracement here. You can see this retracement that is coming and respected this low. So I plotted something like so. And let it like this, something like this. Like this. So I waited for a 4-hour candle to close above this zone. Since after the bounce, this was the highest point that the market came before retracing. So I waited for candle to close above the retracement for me to be sure that it's valid. So this was now the candle that closed above it. So I executed a buy order exactly here. Then stop loss was here. Just like I always say, 50%, the 100% retracement is where you put your first take profit level, which is somewhere here. Just like so. So this is the first level target, 1 to 2 risk reward. So just like this is where how you take your fib bounce. So you don't trade off from this 50% level, 61.8 level. You wait for the bounce off of it. So for example, if that this market dropped up to this level here, then it was a bullish engulfing. In that case, not a tweezer top, because the reason why I took this execution like this is because the candlestick is not my usual confirmation candlestick. So if I had gotten something like come below here and a bullish engulfing candle closed above this zone, my entry should have come somewhere here. somewhere there my stop loss now here. So this is how my entry should have been, like this. Then my first level target comes straight to the 100% retracement. Something like this is what I would have done. So this is exactly how I should have approached it on the fib bounce aspect. I'm sure you understand that you are getting a bit knowledge on how to do market analysis and trade execution. So let's try every process again on another currency pair. Let's try it on USD JPY. Now, don't forget the rule. Don't forget the rule. If it's possible, you might need to take your book and jot everything I'm saying down so that whenever you're going to do analysis, you follow the steps so that you don't miss out anything. Trading strategy is not your problem, just like following it in the right perspective. That is a major problem everybody, almost 90% of people have. So as usual, you come to monthly time frame to look at the overall flow of the market, the overall direction. Initially, if we are looking at USD JPY, initially we have a push to the upside, retracement, another push to the upside. Now we are getting something like a retracement. We are getting something like retracement, and looking at it, we are already seeing a double top at this region. And even in the midst of the double top, we are seeing something like shoulder, head, and the right shoulder to drop to the downside. So this is what we are seeing currently. Now we zoom in to see what direction is possible for this month to go. Now, last 2 months closed with a bullish engulfing candle. That's for last 2 months. Now, last month closed with this bearish candle that you are seeing. And if you look a little bit left, you see that we have a level that the two candles respected. Now this month we might get little bit more drop to at least this level here. So USDJPY might possibly drop a little bit to this level here. If there is no fundamental to back this market up, technically we should drop to this level. So the monthly time frame now is now telling us that we have possibility of coming down below. So which is the direction for monthly time frame is telling us sell. Now, like I did earlier on AUD JPY, I will zoom in to plot my level before I will go to weekly time frame to drag it. That's if your screen is not wide enough, that's when you should do this. But if your screen is wide enough to contain all the candle, you can easily go to the weekly time frame if I'm plotting out any level. But for my case, I'm drawing it here first. Drag it into the future. Like so. So I will now go straight to my weekly time frame. Weekly time frame. Let me check the width of the candle. Okay, we're good to go. So what I'll do is look for, first of all, the lowest point that the market came. The lowest point that the market came. So in this case, we've already gotten one of them, which is here, which is there. I think let's drag it a bit low. So something like this. Yeah. So that's the lowest point. Now let's look at after bouncing up from here, we got the market to come here. Now in that place, do we have previous reactions right there? Let's plot. Let's clone and plot there, then we check back in the history of any level that we clone. Somewhere here. Is it? Let's check back. Okay, so this level is concrete enough. But I can see another level in between, so you just clone this guy again, this bad boy clone. Then you drag it to somewhere here. Yeah, so after breaking out of this level, we got a ceiling here. Then we go back another floor, up, back, ceiling, floor, ceiling, brick, ceiling, floor, ceiling, floor again. So it's also a nice one. So this is also a nice one. Nice one. So now we locate the next bad boy. Clone again. Let me take first to the highest point here. So this was a ceiling before the break. Then after the break, turn back with ceiling, floor, back, then ceiling, dropped. Now we're still testing it as a ceiling. So I'll plot another one again. I'm forgetting to lock, so I'll clone, unlock and drag, just like so. Or here, I think here will be best to get multiple touches. So I'll lock it here now. I can also clone again and take to the next one. Cover more ground as possible. Cover as much ground as possible somewhere here. And you lock it also. Now let me lock all the key levels so that I don't mistakenly shift anyone. Okay, so this is it. So don't forget the monthly time frame already pointed the downside for us, which is a sell market. And if we should plot trend line, we already have something like this coming down. So monthly time frame is telling us that we are possibly going to sell to this support region here. Now we'll go to the weekly time frame. The weekly time frame already is telling us that we are already reacting at a selling level to possibly drop this market. So until we get a bullish engulfing candle that close above our ceiling or our resistance, whatever one you call it. If we don't get a bullish engulfing candle that close above here, we are still going to be following the monthly perspective, which says sell. So we are only going to be looking out for a sell trend on the daily time frame. That's what we should be looking out for. So initially, sell. This should be a retracement. For the sell to continue. Now we'll come to our daily time frame. So this is a retracement on our daily time frame. So we're targeting sell. I can easily plot a counter trend line somewhere around here. This is the first touch, second touch. So it's not even close to breaking. But we need this market to drop because the monthly time frame is giving us a direction that we're coming to this support level. So we're expecting the market to come down. Now on the daily time frame, on the daily time frame is not yet aligned with the monthly time frame. Now for this market to align with the monthly time frame, we are seeing a recent high, higher low, higher high, this now and another higher low with a bit of range. So what we need to do here is that since from here has been on the ranging market, we are going to be plotting a minor zone here. Remember what I said, 50% is a minor zone. I didn't plot it on that side, but whatever time frame, just measure from year to year. The 50% of it should be around here. If you check back in history, you are going to be getting exactly same result. You see, we got reaction there, got reaction. So that's how you plot it. That's how you plot it. So if we break this range, the next place we are going to be coming is here, which means the sell that the monthly time frame is telling us. So anytime we take out this range to the downside, we are selling off first of all to here before the major zone down below. So I'll draw my horizontal, my rotated rectangle, which I used to execute it exactly here on the range, below the range, so that anytime it breaks, I will consider taking trade to this minor zone here. So if we should take, because this one is a recent high, then from here to here, low, higher high, lower high, from here to here, from this place, higher high, higher low, higher high, higher low, higher high again. Then this should have been higher low, but we are testing the recent low that triggered this higher high. So anything that make us to close with a strong bullish bearish engulfing daily candle below this yellow zone now, then we'll go to 4-hour time frame to get retracement, something like this on the 4-hour time frame. This is what we're going to be expecting on the 4-hour time frame. So on the 4-hour time frame, we're going to be expecting something like so, and this, just like this. Just like this is what we're going to be expecting on the 4-hour time frame before we execute our trade right here at the bounce off from this region here. So first of all, a daily candle below this yellow zone. Remember, a strong bearish engulfing candle below this yellow zone here first. Then we come down to daily the 4-hour time frame to 1-hour time frame. 4-hour and 1 hour. Between the 4-hour time frame and 1 hour, we wait for marginal retracement to execute this trade. So remember, this is a counter trend line from the daily time frame. The overall direction is a sell, so this is a counter trend line. So you don't need to play with this counter trend line. You possibly might even need to wait for this counter trend line to break on the 4-hour time frame or on the daily time frame. But I prefer 4-hour time frame. Then you enter your 3D stop loss above this yellow zone. So that's as simple as that. Because this market is ranging, it's not a clear trade to explain the counter trend line or the fib execution So I think with the video so far, you've known how to do market analysis and trade execution. But for the sake of the people that does not understand clearly the trade execution, let me do a quick diagram explanation of what I mean about trade execution. So on trade execution, I'll be doing this clearly on in uptrend and downtrend. So this is higher high, higher low, higher high, higher low, higher high, higher low, higher high. Now the downtrend market, this is lower high, lower low, lower high, lower low, lower high, lower low, lower high, and another lower low. This is a downtrend and this is an uptrend. Now, in an uptrend, you get your trend line somewhere, something like this. This is your trend line. Like so. So, what you do, you see this impulsive move to the upside, this retracement have minor downtrend in it. So this impulsive move to the upside, if this was to be on 4-hour time frame, just like I tell you, 4-hour time frame, then you come to 4 daily time frame. I mean, the trend should be on this trend is on daily time frame. In between from this retracement to this the end of the retracement is a downtrend on the 4-hour time frame. So if this is on a daily time frame, the retracement is going to be a downtrend on the 4-hour time frame. And a trend, for example, is not allowed to take out the low that triggered the impulsive move. So, for example, in this scenario, when we got this retracement and this retracement now triggered another impulsive move to this point here, when the next retracement is forming, this retracement is not allowed to take out this recent low. Anything that happens that we take out this recent low, just know that the market is about to change direction. Simple. So we're not allowed to take out recent low on a trend, bullish trend. So from this point now to this retracement point is a downtrend. So to invalidate the downtrend, and you know that market is now saying, okay, I am ready. I want to start buying now. I want to go back to my original direction, which is my original buying direction. This counter trend needs to get invalidated, which is to say the recent high that triggered the last low is going to be taken out before you can hear the market say clearly that now I want to start buying to my original direction now. So something like this. I know I explained this earlier, but I still need to talk a bit more on it for the sake of the guys that are, because you know that not everybody is fast learner. So we still get something like lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. You might get equal low. Then this lower high needs to be taken out. Something like that. So this is what we call trend inside trend. So initially this is on a daily time frame, going up, come back down as retracement. This daily retracement that is coming, if you come to the 4-hour time frame, you are going to be seeing trend like this. If the trend is not so clear, you come to the 1-hour time frame. You shift from 4-hour to 1 hour to see a clear trend, a clear counter trend. Now that counter trend, this is where now you plot your counter trend line. Then at the bullish engulfing breakout of that counter trend line, and the bullish engulfing should also, or series of candles should close and take out the recent lower high. The recent lower high that created this lower low or the equal low, market should take it out and break the counter trend line. Then you place your order with stop loss below the recent low. I believe you guys understand, but if you don't understand, you can come to my channel with your questions. So break this recent high that created the equal low or created the lower low, whichever one is created. But once you want to, the market is going to tell you that, okay, I am ready to start buying to my original direction. The last high that created the lower low should be taken out with a bullish momentum, which is a bullish engulfing candle. then you enter the trade, stop loss below the last low, just like that. You first of all target the 100% retracement. Initially, in this case, the 100% retracement will be here because this is where the retracement started from. So the 100% retracement will be here. So you first of all target it. Once it's hit, you shift stop loss to break even and start trailing your stop to the final TP. Now, the same thing that happened here, when the retracement start again on the daily, you come back to 4-hour and 1-hour time frame to measure the retracement again. Then as you are getting this trending trend again, so this selling trend again is coming up again, just like this. You see follow the same counter trend line. You see follow the same counter trend line that broke here, something like this. This counter trend line that the market broke here. You are still going to follow the same process here until it break and take out the recent high before you also execute trade. You see follow the rules of take profit at take partial profit at 100% retracement, lock trade and trail stop until you hit your final TP. The same thing happens here. That's how you approach a counter trend line entry on a uptrend market. Now on a downtrend market, this is a downtrend. The retracement of a downtrend market is going to be buy trend, which is uptrend. So the retracement, So the retracement of a downtrend market is a buy trend. So now this point now, from year to year, this is on a daily time frame. If this downtrend is on a daily time frame, from here to here on the 4-hour and 1-hour time frame will be a sell trend. Then this retracement that happened will be a buy trend, something like this. This is how you are going to approach it on the 4-hour time frame with the counter trend line break trade execution. You are going to see something like so, like this: higher high, higher low, higher high, higher low, higher high, higher low. You might get equal highs. Then at the break of this recent higher low, like so, this is where you need to execute your trade. You plot a counter trend line and see if it has been taken out, like so. Remember the rules of trend line must have at least 2 touch to be valid. So once you plot your counter trend line and your counter trend line has been broken, you check the recent high that triggers the last movement. Is it taken out or is market still respecting it? If market is still respecting it, stay away. But if market have taken both the counter trend line and the last high or the last low out, you are safe to execute your trade here. Execute your sell order, your sell position here, and first TP, stop loss above the last level, just like so. Then as market goes in your favor, you continue trailing stop until you hit your final TP. That's the same, just inverse of what the uptrend is. So the same thing applies to this place. This next retracement also is also higher highs and higher low, which is an uptrend. So until you see the same thing I just explained here, until you see it here, you also stay away. Just keep watching until you get a counter trend line break. That's just the logic of counter trend line break. Now let me explain Fibonacci retracement execution. Now for Fib retracement execution, initially I'll shift this guy to this place as a retracement. Initially, when this market moved from year to year, Assuming this place is not in existence, this high is not in existence. This from this recent low to this recent high is where you measure your fib retracement. So from this recent low to this recent high is where you measure your fib retracement to take a trade. So you take your fib retracement to, you measure from here recent high to recent low. Remember, recent high to recent low is for a buy market, so it's for an uptrend. You measure it like this. So when this market is doing the pullback, remember this on a daily time frame. So the pullback, you come to check the pullback, the same rule with the counter trend line trade as a trade execution. So you come to 4 hour and the 1 hour to check the pullback. So during those pullback you are seeing here, inside this 50% level and the 61.8 level, you don't trade there. You just wait for market to come inside that place, play as long as he wants to play. Then once you get a push out, since this is a buy, you are waiting for a buy. Once you get a push out to the upside with a strong bullish engulfing candle with the same rules, take out a recent high that formed the double bottom or the last low, take out it with a strong push and bullish engulfing candle. You execute a buy trade. You are free to execute your buy trade exactly above the fib retracement zone. So you don't execute inside the zone, but you execute as a push out from the zone. Most likely you must wait for the close of that push out. If the candle did not close and you just rushed in and executed trade because you think the market is about to leave you, you might as well see weak. Can the candle come back down with weak and invalidate your zone? You will hit stop loss. So you have to be patient and wait for the close of the candle. Then you put your stop loss right below the fib region, just like this. So then your first level target, the same rules of a counter trend line trade. So exactly the same rules. So this is how you approach it for a buying market. Now for a selling market, if this market was selling like so, if it was selling, this sell you are going to be getting, if this is on a daily time frame, you are going to be getting series of lower high, lower low, lower high, lower low, lower high, lower low on 4 hour and 1 hour time frame from year to year. Then the retracement of a selling market is a buying trend. So the counter trend of a selling market is going to be buy. So from here, assuming this from here now did not exist, so you're going to measure from the recent high to the recent low for a buying market. For a selling market, that's for a downtrend. Something like this. Pick your fib retracement, you measure from recent high to recent low. That's for selling market. So this region here is where you are going to be waiting for the bounce to execute your sell order. So now when this market is selling, you draw your Fibonacci. You are going to wait for the retracement. The retracement will be a buy trend on the 4 hour and the 1 hour. Since you are looking for a trend direction on the daily, so the 4 hour, the 1 hour, the 15 minutes retracement trend is going to be buy trend for a sell. Then you wait for this buy trend to get exhausted at the 50 and 61.8 region. You don't sell off from this zone, you wait for it to bounce. At the bounce off from with this strong bearish engulfing candle, you check if the last low that triggered the buy, the buy trend, if it has been taken out, you can easily place your sell order. But if the market is still respecting that last low that triggered the last higher high of the uptrend, of the retracement uptrend, just calm down until the market take it out. Because if the market do not take it out with full body close, you can also get a strong wick back to the upside and your market will be invalidated. By then you will hit stop loss. But if you patiently wait for the bounce and that first level, that last level that triggered the last leg of the retracement, if that last leg is taken out with strong bearish engulfing candle, that's a clear bounce off from your fib region, then you take a sell trade. You take a sell trade exactly that spot, not inside your fib. Remember, the bounce of it and stop loss above your fib. TP with the same rules of a counter trend line trade. The first TP level here, the second one are the fib retracement and other subsequent key levels, alongside with trailing your stop loss into securing profits. So that's just the simple logic. But remember, the trend line for a downtrend is drawn at the up. The main trend line is coming down. So for a sell trend, the main one is coming down, then the counter is one that comes under. So that's just a clear explanation. Then once you jam a ranging market, the way you take trade on a ranging market is different from the way you take trade on a trending market. Now, for example, this is a ranging market. Ranging markets often look like so. The ranging market have no direction. This guy have no direction, no respect for any man. This guy can take you to village. So what you have to approach this type of scenarios, you draw your zone here. The highest level the market came to, draw it here just like so. This will now be the ceiling. Then you can clone the guy. So let me use my major line tool for clarification purpose. So this is the highest point the market came to. This is now the support, the resistance. Then you clone it. Drag below. This now the support. So this is the support and this is the resistance. So now how to execute trade on this scenario is this. You wait for market to break out on either side. So you wait for either market to break out like so. If the market break out like this, don't just start selling. If you just start selling because you saw a breakout, the market can as well come back inside and hit your stop loss because this is a ranging market. So how you need to approach this scenario is you wait for the market to reduce to this level here. The market to retrace after breaking out, you wait for retracement, then allow the market to continue heading down before you execute. Now to execute, excuse me. To execute, what you're going to do that is after the breakout, the lowest point, if it broke to the downside, the lowest point where the market break to, you take your rotated rectangle. Mark the lowest point that the market came to after the break. You mark it out just like so. Then after this retracement, when the market is coming down, you allow the market to take out that low, the lowest point that the market created when it broke out. You allow the market to take it out, then you put your entry here exactly there. Put your short entry exactly here. Remember, to confirm a break, you must get a complete body close, not weak. So you execute your sell trade here with stop loss above the low that was created during the retest, something like that. But this one you are going to be targeting subsequent key level, looking at the left. So this is how to execute a sell trade on a ranging market. Now, if you are going to be executing a buy trade, which is to say that we broke through the upside, something like this, you are going to be doing inverse. You wait for the retracement, then at the break of this neckline with a strong bullish engulfing close above the highest point that the market comes to, is where you also execute your buy. By then you take your rotated rectangle, plot it on, you plot it on the highest point that the market came to. The highest place that the market came to before retracing. That's where you plot it. Then a bullish engulfing candle closing above that highest place is where you put your buy trade. That's where you have your buy opportunity to enter. Just like so. Then stop loss below the retracement. Then you target subsequent key levels looking at your left, the past histories. So this is how you approach it. But if you still want to approach it on a counter trend line basis, this retracement will also be this retracement you are seeing here coming back to test this place is going to be downtrend. Unlike what I explained here, you are still going to be seeing it here. Then the same rule that applies that at the break, you plot counter trend here. At the break of it, you execute. That's when you can get more early entry than waiting for the neckline to break here. So you get more early entry with the counter trend line break here. Fibonacci don't work on ranging market. For clarification purpose, let me just let you know. Fibonacci entry don't work on ranging markets. So the only entry that can work on ranging markets after the break is the counter trend line. So you stay away from ranging market until the break of it. So on the break of it is where you plot your counter trend line and take the risk of entering early. Or if you prefer to wait for the neckline, which is the most sure one, wait for the highest point to be taken out and execute your trade. Same thing with this. You can also use the counter trend line using the downtrend rule. So these are the ways you execute trades. So if you have any confusion, you can just keep rewatching the video. And apart from rewatching the video, you have any question, you can easily take a screenshot of the places you are having challenges, or easily jot something down. Keep all your questions down. Each time we have classes on Sundays or probably Saturdays, you hit your question to the community. I assure you someone will be there to answer all your questions. You can also come to my DM and drop all your questions. So that's it for complete trading guide to forex trading. So all you need to do is consistently do one thing. Consistently keep doing one thing. So the next phase we're going to be entering is to master the market psychology and risk management. So those are the next two things we're going to be discussing. So as far as trading strategy is concerned, I believe I've broken down every single thing I need concerning strategy here. So all you need to do is just keep watching this video, ask your questions. So subsequently, we're going to be focusing on risk management and trading psychology, and probably market review every Sundays.